We can go ahead and get started. If Nate, you want to take it away.
Certainly. Well, it's great to be here. Thank you, Tom and Dallas, for setting this up. Thank you all for your attendance here. The title of this webinar is Panic Buying an Aircraft in the Fourth Quarter for Tax Purposes. And I thought that was a very good title because, as you can imagine, we're getting lots of calls right now. People looking to buy aircraft, might have had a good year and maybe looking for some write-offs or maybe just thinking about getting into the private aircraft space as the economy recovers, but as the pandemic continues. So it's good to be here. Let me share the screen here.
Perfect. So take it away, Nate.
All right, let me share my screen here. So this is our webinar here. I want to get this disclaimer up front. Usually we put it on the back, but I want to say this very clearly today. Thank you all for attending, but I am not your attorney for this presentation. And even if there may be some clients of mine on the phone, for purposes of this presentation, I'm not acting as your attorney right now. This is for informational purposes to spot some issues and identify those for you in the context of possibly a year-end acquisition of aircraft. But legal advice is very fact specific and context is important. So just beware of that disclaimer up front. I don't know if we'll have a chance to get to all of these things here, but I thought I'd put the most important things, most relevant to our title of our webinar, Panic Buying in the Fourth Quarter. I thought I'd put the most relevant items up front. So part one is basically going to be income tax issues related to acquiring a private aircraft. The most important threshold question is, can I deduct my aircraft expenses? And we'll talk about that and the thresholds for doing that under the current law. Bonus depreciation obviously is another hot topic. There's 100% bonus depreciation. We'll get into that. But the rest of these sections under Part 91 go into the hurdles that you can face in getting bonus depreciation and getting tax deductions for the aircraft. There's aircraft are what is called listed property under Section 280F. And so you have to have enough qualified business use to take bonus depreciation. There are limitations if your business always runs a loss, and the IRS might consider that a hobby loss. There are limitations, or actually a deferral of deductions for what they call excess business losses for individuals. We'll talk about those. We'll talk about passive activity issues that can arise if you are leasing or chartering out your aircraft. And finally, there were new regulations issued earlier this year regarding disallowance of deductions for employee commuting. So we'll talk about those as well. If we have time, we'll get into a couple of state tax issues that may be relevant to a year-end deal. But that's basically our agenda there.
Perfect.
So let's talk about income tax. We get this question all the time. Can I deduct my aircraft expenses? And the answer is yes, if you're using it in a trade or business. And I highlighted that and animated that because that's the very important threshold question here. Under Code Section 162A, you are allowed deductions for the ordinary necessary business expenses incurred in conducting a trade or business. And that's the term of art, trade or business. Sometimes we hear, well, I'm going to use my aircraft in business. And you need to go a little bit deeper in that. It has to be used in a trade or business in order to take deductions and depreciation right now. Some people say, well, I'm going to buy an aircraft and I'm going to use it in connection with my employment. I'm just an employee of this company, but I can use my aircraft for business, but my employer isn't going to pay anything for it. The business of being an employee is a trade or business, but it happens to be a non-deductible activity right now under current law. We'll get into more of that later. But initially up front here, I want to talk about you have to use it in a trade or business, but you have to start preparing to make the argument to the IRS that it's an ordinary and necessary business expense. Do you have to travel by air? Lots of people have to travel by air for their business. So you usually can meet that, but you also have to show that is the need appropriately met by private aircraft? Is it helping my schedule rather than spending time in airports, traveling on commercial airlines? Is it improving my productivity? Is it allowing me to do itineraries I couldn't do in the commercial airlines? We'll get to factors that you can identify for the IRS to show that. But that's the other question you have to add is ask yourself and qualify for is it an ordinary necessary business expense? And in this regard, think about whether you're buying the appropriate size aircraft for your profile. It doesn't make sense to buy a 7,500 nautical mile range aircraft like a Global 7500 if you're just using it to fly from the Bay Area to Los Angeles with 2 people. That's not an appropriate type of expenditure. Are you buying an aircraft even though you're only going to use it 25 hours a year for business purposes? That's also not an ordinary necessary expenditure. Is it a common business practice? Do you have a need for a private aircraft if your business is strictly limited to Northern California, let's say? You don't really need a jet aircraft to fly between Sacramento and Oakland for business purposes because it's probably close enough to drive. So those are the kind of questions you have to be asking yourself, whether it's an ordinary and necessary business expense. I want to get into section 212, production of income deductions. So this goes back to the question we get asked sometimes. I'm using my aircraft in business, and the business is undefined. They don't say trade or business, but they say, oh, I have investments all over the world, all over the country. I need to travel to, see how this company is doing that I have a 10% stake in. But I'm not a CEO or officer or director or anything like that. But I just want to fly to New York and visit the company to see how my investment is doing. That's kind of an investing activity, and it may be deductible if it's an ordinary necessary business expense under section 212. This deduction is available only to individuals. It's not available to entities of any kind. But the thing to realize is that the Tax Cuts and Jobs Act from 2017 suspends until 2026 all miscellaneous itemized deductions. And section 212 is the type of deduction that's suspended for a few years. So we literally do not have the ability to deduct expenses for the production of income. And again, production of income is a business activity that doesn't arise to the level of a trade or business. It's just an investing activity or that kind of thing. So 212 is gone right now. Is there a question, Tom?
Yeah. In this instance, what is the definition of a trade as opposed to the definition of a business?
Yeah, there's not very much published on that. I mean, there's a lot, you kind of have to glean it from a lot of different cases. So a trade or business, and that's the term rather than just talking about trade, people say it's a trade or business. It's something with regular income. It's something with regular expenses. I mean, the income doesn't have to be, monthly or quarterly or yearly. I guess you could have big payoffs, where your income is kind of lumpy from year to year. That's possible, but it has to be something engaged in on a regular basis. And it's something more than just an investment, right? Like an investing activity would be literally you invest in a company, all you do is pay money and hope that the stock goes up. That would be not a trade or business. I mean, it could be a trade or business if you're in the business of being a stockbroker and holding stuff and making markets and holding equities for inventory or something like that. So that would be a trade or business, but just investing activities is not a trade or business. So providing services, making widgets, manufacturing, that kind of thing, not just investing activities.
Okay, continue.
So here we go with possible arguments for the IRS. And it's important here to be able to tell your story to the IRS if there's an audit regarding your private aircraft. You got to identify for them reasons why it's appropriate for you to have a private aircraft. Reasons why it is an ordinary necessary business expense. And here's a list of reasons that we've come up with. It's kind of in the list of a I've indicated check boxes here, and not all of these are going to apply to your situation. You don't have to show all of them in order to get deductibility for your aircraft, but this is a list of possible arguments that you can use. So you got to be able to shape and tell your story to the IRS about how the aircraft helps your executives be more productive, how traveling on private aircraft allows you to get work done, how it allows you to travel to cities where you conduct business where there's not appropriate airline service, show how you're able to work on the flight and travel together in close quarters when you really can't do that on the commercial airlines. It may be possible to argue that if we own our own aircraft, it's better to run this particular trip than using the airlines. Well, first of all, there may not be airline service, but second of all, it may actually be cheaper than chartering your aircraft for that particular trip if you own your own aircraft. So there are lots of arguments that you can make, and the point is that you have to be able to tell your story and specifically be prepared when the IRS comes knocking, if the IRS comes knocking on an audit about why this is an ordinary necessary business expense. Again, a list of potential audit flags that that can come up during an income tax audit. I mentioned these before. So the biggest item that people want for an aircraft, or the biggest expense that people want to be able to deduct on their income tax return is depreciation. And depreciation, there's actually three different types of depreciation here. There's one, the market depreciation, that's the difference between what the blue book says your aircraft is worth retail new and what it's worth 5 years now. That market depreciation, the value of the aircraft in the open market, what that is over time. Book depreciation is a financial accounting estimate, and it's conservative, and it's made to show owners and investors what the assets of the company are worth, and that's a conservative accounting estimate. It's not related to market depreciation, but it's intended to be probably a little bit more conservative than market depreciation. But relevant for our purposes today, we're talking about tax depreciation, which is a deduction on your income tax return for aircraft used in business. The reduction in value of the aircraft over time is a cost that is incurred in conducting your business. So that's one of its purposes. The other one is to try to match the income that the asset produces to a deduction for that asset. Now, for aircraft with bonus depreciation and accelerated depreciation, that doesn't have anything to do with reality. We have accelerated depreciation, we have high bonus depreciation. And this slide here shows that there can be vast differences between the market value, the book value, and the tax value of the aircraft. When you depreciate an aircraft, the tax value on your books goes way, way down. You're taking those deductions against your income. And so your basis in the asset, what the asset is worth less its depreciation, becomes very, very low. So there can be a wide mismatch between those three numbers there. So the important thing to realize, as I said before, we don't have 212 deductions anymore, Section 212 production of income deductions. We only have the ability to deduct and depreciate aircraft that are used in a trade or business. However, aircraft are what they call listed property under Section 280 capital F. And listed property imposes, the listed property rules impose requirements for you to be able to take accelerated depreciation. Well, both accelerated depreciation, so-called maker's depreciation, and bonus depreciation. If you don't qualify under the rules of 280F, you only get to take straight line depreciation. And there are a couple asset classes. These are published by the IRS in the publication called How to Depreciate Property. And aircraft fit into one of two classes. Asset class 00.21 is aircraft used in business. These are typically Part 91 aircraft. And they're either subject to a 5-year accelerated depreciation, maker's depreciation, or a 6-year straight line. For assets that are used in the commercial carrying of passengers, like Part 135 aircraft, it's a 7-year maker schedule or a 12-year straight line schedule. For aircraft that might do both Part 91 and Part 135 activity, you would pick the class that predominates. So if if your business use is mostly 135 charter, you use asset class 45. If it's predominantly 91 use, then you use asset class 0.21. I see a question here. I don't know if anybody can see it here, but for a business registered in California, can you depreciate and write off expenses as an LLC, or do you have to be an S corporation? That's a very interesting question. It goes to the type of taxpayer that you are. The aircraft can be owned obviously by different entities. You can own it in an LLC that has a single member. And if that single member is an individual, then the IRS considers it as the individual just buying the aircraft. And so in order for the individual to deduct and depreciate the aircraft, the individual would have to have what's called a Schedule C business, which is like a sole proprietorship business. So if you are an individual and you have a sole proprietorship business and you use the aircraft in that business, yes, you can depreciate and deduct the aircraft. There are obviously other types of taxpayers. There are corporations, and that can be an S corporation, which doesn't pay entity level tax, except in California, there's a 1.5% income tax at the S corporation level. It's not an entirely pass-through entity. Or you can have a C corporation, which pays the corporate tax rate, what is it, 25% now at the C corporate level. And then any distributions to the shareholders of the C corporation are also taxed. So C corps, S corps can write off the aircraft, and S corp basically passes through that depreciation to its members. An LLC that has multiple members is treated as a partnership for tax purposes. So that partnership would take the tax depreciation if it had a trade or business that it used it in, and then those depreciation deductions would be passed through to the members of that LLC. So yeah, that's a good question. And any type of taxpayer can use deductions or depreciation if it has a trade or business that it uses the aircraft in. So that's a good question. So I mentioned 5-year makers, 7-year makers on the previous slide a little bit. And again, if businesses, Part 91 business is the predominant use the 5-year accelerated, 6-year straight line, or if charter is the predominant use, 7-year accelerated or 12-year straight line. So what is bonus depreciation? So bonus depreciation is not extra depreciation, it's just more accelerated depreciation. And right now we have 100% bonus depreciation, but it's not more than 100%. You only get to depreciate up to 100% of the cost of the aircraft. You don't get to deduct more than that, just as much of that. The question is, how soon do you get to deduct it? And bonus depreciation, 100% bonus depreciation means you get to deduct it all in the first year. This isn't just a giveaway to aircraft owners. It applies to a broad range of capital assets, and we've had bonus depreciation in some form or another for many years now. It just happens to be 100% right now, but I think we've had it since 2001, 2003 timeframe. It started as 30%, then it was 50%, and then it was 100%, but only for new aircraft, but now it's 100% for new and used aircraft since the Tax Cuts and Jobs Act went into effect. It applies only for assets acquired after September 27th, 2017. And people might question, well, why is that date important? We're talking about now, right? That's years ago. Well, consider this point. If you bought an aircraft after September 2017, but used it personally, but now you want to use it in your business, there is the potential for bonus depreciation if you convert that aircraft to business use. But if you had bought the aircraft prior to that date and it wasn't used in business, But then you later converted it to business use, you would not have the ability to take bonus depreciation. You'd still get regular depreciation, but not bonus depreciation. But kind of looking, go ahead, Tom.
I want to ask you a question because I think I understood what you said. If you buy an airplane in 2018 and you're using it personally for a couple of years and then decide to start using it in business, you can then use bonus depreciation. Did I understand that correctly?
Yes, that's correct.
What do you use to determine the value? Because it's not at the point that you start using it in business, do you go back to what you paid for it?
I forget what the rule is there. I think it's fair market value at the time of the conversion to business use.
Okay.
But that's a good question. I'll have to get back to you on that. But the important thing to realize is that you can't have a depreciable interest in the property at any point prior to the conversion. So if you or a related company or something like that, so we'll get to that in a couple of slides. We'll talk about it a little bit more.
Okay.
But if you've had the ability to take depreciation, but you didn't take it, you don't qualify. So if you've used it in a business, but happen not to have taken depreciation at that time, then you won't qualify for bonus.
Okay,
So
so that what we're talking about only applies if they were making strictly personal use of it.
Strictly personal use of it, yes.
Got it.
That's correct. So the key point here is qualifying for bonus depreciation requires you to qualify for maker's accelerated depreciation under the listed property rules in 280F. So that's the important thing. To get bonus, you have to qualify for makers, and qualifying for makers, these aren't new rules under 280F for qualifying for makers. They've always been there. But people sometimes forget about them, and that you have to use the aircraft in a certain way in order to get makers depreciation.
Got it.
So we've got 100% bonus depreciation this tax year and through the end of 2022. 100% of the purchase price is deductible in the first year. It also applies to improvements to property that are also subject to bonus depreciation. So if you're upgrading your engines or avionics or interior or otherwise making some capital improvements to an aircraft that is of a type that would otherwise be subject to bonus depreciation, you can bonus depreciate those improvements as well. So in that next bullet there, I mentioned, as long as you had non-business use previously, you can either 212 or 162 business use. As long as you had neither of those, you could convert personal use property to business property and get bonus. But you can't do things like transfer the property, to somebody else, then buy it back, or transfer it among companies. There are rules against what they call churning, moving the asset around, selling it, then repurchasing it in order to, be re-eligible for bonus depreciation. Now the thing to realize is that if you don't remain eligible for maker's depreciation during its entire depreciable life, during that 5-year or 7-year maker's period, then the IRS gets to recapture that depreciation. We'll talk about that in a slide or two. So that's why complying with 280F is important, because they get to recapture the depreciation that you've already taken. One of the things, since California income tax rates are going up and up and up, there is no bonus depreciation on the state income tax return. It's a federal income tax return only. A couple of inside baseball issues here. I don't know if we have any dealers of automobiles, boats, or farm equipment that use floor plan financing, to finance inventory. If you're that kind of taxpayer using that kind of financing and deducting that kind of interest, you don't have access to bonus depreciation. So I know there are a lot of car dealers and farm equipment dealers that have operations in many states that use aircraft. So if anybody's in that category, something to watch out for there. So we've got 100% bonus during this year until 2022, but note that bonus depreciation under current law is scheduled to go down. Excuse me, move the slide there unintentionally. bonus depreciation goes down in 20 percentage point chunks over the next few tax years. So in 2023, it's 80%, then 60%, then 40% in 2025, 20% in 2026, then no bonus depreciation in 2027.
So because it's not bonus depreciable doesn't mean you lose the right to depreciate it. You just have to go to the straight line or the maker's method.
Yeah, that's correct. So 5-year makers, 7-year makers, you're still writing off the aircraft in 6 or 8 tax returns. So it's still very accelerated because these are much longer lived assets than 6 or 8 years. So you still just get the regular maker's depreciation or straight line depreciation, which is 6 or 12 years, depending on the asset class. So this says you get 100% bonus depreciation, then 80%. You get that bonus depreciation on that 80%. And then for the remaining 20%, you just depreciate that on the maker schedule.
Got it.
Yep. I'll probably go briefly over these couple slides here. You'll notice these dashed lines in this previous slide here. If you have a binding contract to purchase an aircraft and you sign it before the end of 2022, you still get 100% bonus depreciation in 2023 if you place it in service in 2023. So those dashed lines there mean if you have a binding contract, your 80% or 100% deduction will still apply if you place it in service in the following year. But there are some requirements for a written binding contract. It's got to be enforceable under state law. The key thing to realize is that liquidated damages, which are very common in new purchase agreements with manufacturers, they have to be at least 5% liquidated damages in order for the contract to be considered enforceable. Now, often there's liquidated damages to the buyer if they cancel the purchase agreement with the manufacturer, but the seller must also have liquidated damages of at least 5%, or otherwise the contract is not considered a written binding contract. So this is a key issue that's very often overlooked in negotiations with manufacturers. So I think we'll be, unless the law changes, we'll be hearing a lot about this towards the end of next year and the year after. This is just a numerical example of the effect of bonus depreciation. It's the same amount of depreciation here, $3 million. It's just taken up front rather than over the 6. This is a 5-year maker schedule on the right. You take the same amount, it's just that you take it sooner. And if you get more deductions sooner, it's a present value calculation, right? So what's the value of more dollars in your pocket today versus dollars in your pocket in the future? So it's a net present value calculation. So this is just a numerical example considering the value of the aircraft. Assume your cost of borrowing money or the opportunity cost of your capital is 4.5%, and that you have a 35% tax rate. Probably a little higher cost of capital and a little on the low side tax rate. But if you do the math, it turns out that bonus depreciation is maybe worth 2.6% of the value of the aircraft. And if your cost of capital goes down, that number gets smaller. If your tax rate goes up, the number gets bigger because you'd rather have you save more sooner. So it's just a green eye shade calculation that you or your accountants can do to figure out what the actual benefit to you of bonus. Now, it may be, really important for you to get bonus this year because you have a liquidity problem, and so your cost of capital may be really high. You can't borrow any money. You really need the tax write-off. So there are some special situations like that, but you should always ask yourself whether you should use bonus depreciation. It is a really good time to use bonus depreciation now at the end of the year when you might have to pay more for an aircraft. And what are you trying to avoid in taxes? One thing you should worry about is if you're trying to offset long-term capital gain income, which may be taxed at a much lower rate, say 25%, you should be very careful because, you may use bonus depreciation to shelter income on, say you sold your company and had a big exit. it might be taxed at long-term capital gain rates, but when you go to sell the aircraft, the recapture will be at the ordinary income rates, which will probably be very, very much higher for you, 35, 37, 39%, depending on what Congress does. So you get a lower tax, you get a shield income that's taxed at a lower rate now, but you have to get that back when you sell the aircraft at a much higher ordinary income rates. And again, if we think tax rates are going up next year, do you want to take bonus depreciation at this year's tax rate, but then pay the bonus depreciation back in future years when tax rates may be significantly higher? And one thing to realize is we've been talking about 280 capital F, that section of the code, all through this presentation, the listed property rules. So if you fail that 280F test during any of the first 5 or 7 years of the maker's schedule, then you get to recapture the bonus depreciation, and you basically have to switch to straight line depreciation retroactive to when you purchase the aircraft. You recognize gain all in that year, the excess depreciation, and so that recapture could occur a lot sooner than you might expect. So if you don't think you can keep your business use of the aircraft up, you might have a recapture event sooner than you think. Let me go here. I'm going to switch gears a little bit to 280 capital F, go into some of the details here, because people can kind of be searching for a trade or business use of the aircraft before the end of the year. Got to find a trade or business to use the aircraft in. People say, well, what if I lease the aircraft out or use it for charter or do this or do that? I don't have a trade or business, but I can kind of come up with something. And there are some risks to that, and I'll get to those issues in these slides here. So again, you have to have at least 50% trade or business use to use maker depreciation. And you need to qualify for maker's depreciation in order to get bonus depreciation. Here's some ways to fall out of the maker's depreciation. Here are 3 categories of business use that are, I guess, shall we say, disfavored by the IRS. So if your business use of the aircraft is leasing it to a related taxpayer, like leasing it to an S corporation that the taxpayer owns, or the aircraft owned by an S corporation leasing it to the owner, that's considered leased to a 5% owner related person, and that's not qualified business use. If there's too much personal use by a 5% owner related person, say it's for compensatory business use by the executive, giving that executive a perk, that's not considered qualified business use under 280F. If there's too much business use by non-related persons and you don't appropriately impute them income, that's also business use. That's not qualified business use. So you got to watch out if you're trying to do a lease or personal use of the aircraft, that's not qualified business use. Now there is an exception here for aircraft. If you have at least 25% pure trade or business use, then you can use those 3 problem categories to get you above the 50% threshold. So if you use 25% in the trade or business use, then you can use the activity of leasing to a related party to get you to the 50% threshold. Then you can use personal use by an individual, a related person, personal use by the related person to get you above 50%. Then you can use other employees' use of the aircraft to get you above 50%. I see a question here. What is too much leasing or too much personal use? Can you quantify it? Well, the 50%, 25% tests, it's interesting because everybody used to do it based on like total flight hours of the aircraft, right? If you had at least, say you had 100 flight hours of the aircraft for the year, just for numerical simplicity there. If you had more than 50 hours that were qualified business use, then you would qualify for maker's depreciation. If you were under 50 hours, then you would have to switch to straight line there. Now, there are some, obviously aircraft travel for many different reasons, and passengers on each flight also travel for many different reasons. There could be some business passengers, there could be some personal passengers, there could be some entertainment passengers. There is some authority out there for the idea that you have to count the use on a seat-by-seat basis to figure out whether you're 25% or 50%. It sort of is in tension with the idea under other regulations in 280F that the primary purpose of the flight governs there. It's basically based on flight hours typically, but you and your accountant will have to decide what strategy you use, whether you do it on the primary purpose of the flight or you count it seat by seat. This slide here kind of goes into what I was talking about, what they call the leasing company trap. As I said, related party leases are not considered qualified business use of an aircraft under 280F. But for aircraft, they would be if you had 25% traded business use. But set that aside for a minute. Let's just consider an individual here that buys an aircraft and he's the CEO of an S corporation that he owns more than 50% of. So the individual and the S corporation are related parties. So suppose the individual doesn't have any personal business use of the aircraft. His only business use of the aircraft is exclusively leasing it to the S corporation for its business use by himself, actually, as the CEO. None of this activity here would be considered qualified business use, because on this, for the individual's taxpayer, the only business use he has for the aircraft is leasing to this related party, and he's using the aircraft. So you really, so this is the kind of structure. Oh, I want to hurry up and buy an aircraft before the end of the year. I don't really have a business use for it, but my company can use it, but I have to lease it to my company. So this is kind of the prime example of, rushing through a purchase and not thinking about the structure. You fail the 280F test, you don't qualify for makers, you don't qualify for bonus, and the depreciation benefit that you thought you were getting isn't there. So this is an example of where it really can go wrong. I know I'm going kind of long-winded here. I'll go through quickly some of these other limitations here. Another thing to worry about is hobby loss limitations. If you set your aircraft inside a business that never makes money, that whole activity might be considered not for profit, and so the IRS may consider it all those losses to be non-deductible. It's not that they're suspended; it's that they're not deductible at all. And there's kind of even a worse result under the Tax Cuts and Jobs Act, that if you get income from that hobby, you can't use any of the deductions to offset it, because they're miscellaneous itemized deductions that are suspended until 2026. So a bad situation there. So you got to be really careful about where you put the aircraft, what taxpayer you put the aircraft in, so you don't worsen or create a hobby loss problem. Another thing that can blunt the benefit of bonus depreciation is if you have excess business losses. So section 461L limits deductions for excess business losses. So let's say you have a business that you conduct through an S corporation or a multi-member LLC in which you are a partner. So if that taxpayer, that S corp or that partnership acquires an aircraft, and then that entity passes through a large loss to you on your K1 at the end of the year, those losses from those trades or businesses are limited to the individual in 2021 to $262,000 if you're single, or $524,000 if you're married. So it's not that they're disallowed, it's just they're suspended until the next year. So if, let's say, you had put an aircraft in the S corporation and it caused the S corporation to pass out a $10 million loss, and you're thinking, oh goody, I get this $10 million loss K1 that I can offset against my $20 million in other income that I have personally. Well, what 461L says, and you can only deduct up to a few $100,000 of that loss, and the rest you have to carry over into the next year and use as a next net operating loss against your income next year. And you may not have income the next year. You can carry it over from year to year, you know, indefinitely. But if this is the big tax year for you that you're trying to deduct and you're not anticipating big income in future years, then you may not get to take advantage of it. So EBL limitations are the big thing that can limit the ability to take bonus depreciation. So something to watch out for there. Passive activity loss limitations. If you're leasing or chartering the aircraft, besides the 280 capital F issues, if you're leasing or chartering the aircraft out, it's considered a passive activity unless you have other passive activity income. You won't; those losses are suspended until you get other passive activity income. Passive income are income from trades or businesses. There's that term again: trades or businesses in which the taxpayer does not materially participate. And that kind of income is pretty rare. It doesn't include investment income, because investment income isn't a trade or business income. So you can't offset passive losses against investment income. So the issue here, you know, I had this just the other day. A client came and said, well, I bought this aircraft, but should I put it in charter this year? I don't have a lot of business use for it in my own business this year, so maybe I should put it in charter this year. And I said to him, well, no, absolutely, you shouldn't use any charter this year, because that would turn all of your depreciation deduction for the aircraft into a passive loss for this year, and it would make your depreciation deduction get spread out over many, many future years. So that's a situation where you need to plan. You know, again, acquiring the aircraft before the end of the year may be hard to get an aircraft on a charter certificate before the end of the year anyway, but if you're thinking about doing that, that could turn your depreciation deduction to a big passive activity loss, which you might not be able to take advantage of. There are some opportunities for grouping your passive activities with active activities, but very detailed. You have to plan with your accountant and see if it makes sense, and not every taxpayer can take advantage of it. So passive activity is definitely another issue you need to consider about in a year-end purchase. Here's another thing to think about, is that 274L under the Tax Cuts and Jobs Act disallows any deduction for transportation of an employee between one of his residences and its primary place of employment. So it's not just CEOs, it's any employees, not just higher up officers, control employees, CEOs, CFOs, directors. Well, it excludes directors, but if you're using the aircraft to provide commuting to the employee, that's non-deductible. Now, it used to be the case, you know, if you had an S corporation or partnership and you're carrying around, you know, commuting, not for entertainment purposes, but just commuting between the residence and a place of business, so long as you imputed income to the employee, that the whole flight was disallowed, the whole flight was deductible. But under this section, commuting is no longer allowed as a disallowance. So this is, if you're thinking that, if you're planning on having a lot of commuting use for the aircraft in the first year, that may result in disallowance of a lot of your bonus depreciation. So that's something to be worried about. There is kind of an exception here for, you know, if a reasonable person would consider it unsafe to use public transportation, then you can, that's a pretty loose test, then you can use the disallowance for commuting. So that's something to think about there, but commuting is definitely a hot button item to consider with whether you're using an aircraft, in whether it's deductible and you can use bonus depreciation. I will mention use of the aircraft for entertainment purposes, since this comes up a lot. Let's say you buy a business aircraft right before the end of the year, and a lot of it is used for entertainment purposes. for the employee of the taxpayer. There are entertainment disallowance rules under 274E2 and regulation 1.274-9 and -10, which disallow depreciation deductions, actually all deductions for the aircraft, but especially depreciation, if to the extent the aircraft is used for entertainment. So if 75% of your flights during the first year are for entertainment, then you've just lost 75% of the bonus depreciation, the 100% bonus depreciation deduction. Now, this is something to think about here, is that for purposes of the disallowance calculation, you can elect to treat the aircraft as having been depreciated on the straight line basis, which results in much lower depreciation being subject to the disallowance. So this is an affirmative election that you have to make. You should talk about it with your accountants if you think that's going to be a thing. But there is some relief there in the regulations that allow you to use bonus depreciation in the case of an aircraft that's used for entertainment. One more slide, I think, here before I get to the state tax issues. There was a IRS chief counsel advice earlier this year in April that seemed to indicate that for sole proprietors that purchased aircraft, if there were entertainment passengers aboard that aircraft, you had to disallow deductions for using the aircraft based on those entertainment flights. So let's say the aircraft, the primary purposes of the flight was for the sole proprietor's business, but he carried 2 or 3 friends along that were traveling for entertainment purposes. The old, well, not the old rule, but I think the current rule, the rule that everyone understood to be in place, was that the primary purpose of the flight determines whether the flight is deductible in the case of a sole proprietorship. But we had this chief counsel advice that seemed to take the opposite position. So it's contrary to a lot of advice, but I had some questions from clients about that. It seems that NBAA has confirmed to the NBAA tax committee folks that this was not an official IRS position. I don't think it's defensible because they would have had to amend the regulations and do a lot of other things, and many court cases would have to be overturned. But this is an item of concern that I've heard mentioned, but I think it's died down for now. I guess we have about 10 minutes left, and so I'm going to leave time for some questions, but I want to get into the state tax issues here. One thing relating to placing aircraft in service before the end of the year, if you're in California, remember about property tax. Property tax is based on whether your aircraft is habitually situated in California as of January 1st of a particular year. So if it's habitually situated in California, even if it happens to be absent from California on that particular date, it'll still be subject to California property tax. Now, for California, people that are going to base their aircraft in California, and let's say they acquire it on, at the very end of the year, say December 27th, I think it would behoove that person not to have the aircraft come into California until well after the January 1st lien date, because otherwise you're paying a full year's worth of property tax just for using the aircraft in California for a few days. So instead of
Nate, that's the same advice we as sales tax people give to our clients.
Yeah, absolutely.
At the end of the year in December and not bringing it into, because that's the only year that you can use that that date to your advantage, and that's the very first year you own it. So if you buy it in December of 2020, yet the first time you bring it into California is just January 1st, 2023. If you wait until after January 1st to bring it into California for the first time, you can avoid the property tax for that first year.
Yeah. And you really want to be clean about it. You want to close outside California. Don't make any landings in California until well after January 1st. Don't sign any hangar agreements in California for the aircraft. Don't have any connections of the aircraft to California until well after that date. Because, I don't think literally the state has any jurisdiction to tax property that has never been in California at any point prior to or on January 1st. How can the aircraft be habitually situated in California if it never visited California on or prior to January 1st? So that's, I think that's a key planning point there. And you think, well, that's just a loophole, but think about it. I mean, you could pay property tax and then decide to sell your aircraft on January 15th, and you don't get any refund for that. So, they can't just win it both ways. You lose if you decide to sell your aircraft earlier in the tax year. There's no refund or proration for use of aircraft that way. There are 50 states. I feel like I should break into song here, like a Schoolhouse Rock, about there being 50 states in this great country and blah, 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 blah. But there being 50 states in the country is a real pain because every state has different sales and use tax rules here. And these assets are very mobile. They go to many, many states. And so state and sales and use tax is implicated in all except Oregon, Utah, a handful of other states. Some states like Oregon and Montana don't have any use tax. Other states have exemptions for aircraft above a certain weight. Other states have flyway exemptions. You've got to track every particular state, where you close your purchase or where you might be using the aircraft. So, just focusing here on the West Coast, Washington, where I am, is probably the worst state in the country for sales and use tax on aircraft. It's just absolutely horrible. They'll get you going and coming, and sometimes both. Been involved with some very absurd audits with the DOR up here, unfortunately. California, fortunately, has very favorable exemptions for aircraft, which Tom has been very, very successful for our clients. The interstate commerce exemption and the common carriage exemption. But you have to plan in order to succeed at those exemptions, and Tom will help you succeed with both of those exemptions, but you got to plan first. Nevada has some exemptions for interstate commerce, not as well worn, not as good as California, but you should think about, wherever you have other places of business or other residences, even if you might not be considered an income tax resident of another state, you probably have sales and use tax exposure in that other state. I want to get to the question here that we have in Q&A, and I'll just read it to you. In the past, I've always taken delivery of my planes in a different state, not California, and possibly going to trade in my current plane. Well, is that a delivery in a different state? Any issues? So there may be a couple things going on here. One is there in some states, there's what they call a trade-in exemption for personal property. Like in Washington, we have that here. If you trade in your automobile for a new automobile, you get to deduct the fair market value of the old automobile against the purchase price of the new automobile. So you get a trade-in credit. And so you pay sales tax on a much lower amount. California doesn't have that trade-in credit on aircraft. I don't think they have it on automobiles either.
No, everything in California is taxed on.
Yeah, everything is taxable. Right, exactly. So there's no trade-in exemption to worry about in California. Oregon doesn't have any sales or use tax. Not sure about Nevada where they have a trade-in exemption. But it's important to close all your transactions in the states where it makes sense, right? So let's say you own an aircraft and you're trading it into a dealer or a manufacturer. That transaction could very well be subject to tax. If the dealer is not really a dealer or hasn't completed the paperwork or doesn't have a sales tax exemption certificate, that transaction could be subject to tax. And if that's in a particular state, and if that's the case, you may want to close the trade-in sale in a place like Oregon or Montana that's tax-free. And the interstate commerce exemption for California, as Tom will tell you, you have to close outside California and do a business flight, interstate business flight with passengers entirely outside of California in order to do the interstate commerce exemption. So closing where you close the sale of your trade-in sale and your new property purchase is very important for sales and use tax planning. I was just involved, I know, a year or so ago, not quite a year ago, that involved Wyoming and Montana and Idaho and Washington in a complicated trade-in structure. And we had to meet the letter of the trade-in requirements for all of those states that were involved. So where you close the aircraft, where you use the aircraft, it is very important in structuring that kind of trade-in process. I think we just have an hour, Tom, is that right? We've got a few minutes left, open for questions. I've tried to go through, the income tax things that you need to worry about the most in doing a year-end purchase and making sure that you can qualify for the bonus depreciation. Obviously, there are other limitations like, there's no inventory out there, right? The inventory is at all-time lows right now. Slots for pre-purchase inspections may not be available. I can't get financing in place, prior to closing. There's other limitations there. And with the low inventory, you may end up having to pay a much higher price than you thought for this particular aircraft. So there's a lot of challenges out there. It's also challenges. There are also challenges for current aircraft owners that want to upgrade. There may not be inventory for them to upgrade into. They may be able to sell their current aircraft quite readily, but getting a replacement aircraft may be a tall order. So that's something else impacting the market. But
And the other thing that's going
ahead,
on
Tom.
at the end of the year is that because there's reduction in inventory and an increase in the amount of people that want airplanes, it drives the prices up. So you have to take all that into consideration.
Mhm.
You get involved in these plans to buy an airplane at the end of the year and make sure that you have all your ducks in a row, that it makes all sense, because you just have to be smart. Don't buy an airplane if the only reason you're buying an airplane is for the tax benefits, without getting an aviation attorney who understands all the tax benefits, the loopholes, the pitfalls, anything that can come back on you, because sometimes rushing out to buy an airplane raises the price and your liabilities along the way. So I'm not trying to tell you not to buy an airplane in the last part of the year, because we're all in the business of getting new clients at this time of the year, but just make sure that when you're buying an airplane, that you understand the ownership structures and the income tax obligations, as well as, from our point of view, understand the sales tax obligations and how you can, all those, as Kevin used to talk about, there's a whack-a-mole game that goes on here: property taxes, FAA rules, sales taxes, income taxes. You've got to put all those together at one time and look at them all simultaneously, or you could wind up with something that you didn't really intend.
What do they say in the military? The 6 Ps: proper planning prevents pretty poor performance. So it's the same thing here. You have to plan, because there's lots of different income tax and sales tax rules that can bite you. I see a couple more questions which I'd like to answer.
Great.
One here says we're based in California, but if we were to buy a plane in another state, would we not have to pay property taxes on it in that state? I think the answer is yes, because property taxes are based on where the aircraft is habitually situated, where it's primarily hangared. So if it visits another state from time to time, or you take delivery there, it should be subject to property tax. But aircraft can in fact have multiple bases. It could be based in California half the year, and it could be based in another state for half the year. And in that situation, you might end up paying an apportioned property tax to both states. Say 50% property tax to each state. So that is a possibility. But if you're just closing in the state, you probably shouldn't have to worry about property taxes. Another question here, my understanding is California does not allow for bonus depreciation as the same schedule as IRS. That's generally correct. The question is a little, the phrasing is a little inapt there. Bonus depreciation is a one-time first-year event, right? It's either 100% in the first year or nothing. So it's not really a schedule over multiple years. It's just in the first year or isn't. So you're correct that California does not allow bonus depreciation in the first year. However, California does follow the federal depreciation schedules, the MAKERS 5-year, 7-year, and the straight line schedule. So other than bonus depreciation, you depreciate property the same way in California. And sorry here, I guess I misunderstood the previous question regarding closing an aircraft in another state. So recommended not bringing the plane into California if you bought it in late December. Oh, I see what you're saying. So if you keep an aircraft in another state and keep it outside California, would you have to pay property tax in another state? Well, the answer to that question, in a state like Oregon or Washington, they only have nominal aircraft registration fees, and I think they don't even kick in until 30 or 60 days of presence in the state. So if you're just keeping the aircraft there for a couple weeks, you shouldn't have to register the aircraft there. But that is an astute question otherwise, because there may be another state that you keep it in that may have property tax on aircraft, and if it's habitually situated there on the lien date, yeah, you could end up with paying property tax in that other state because it's habitually based there on lien date. So yeah, you want to be careful about what other state you bring it into. I think Arizona would be one that you wouldn't want to keep it in. I don't know when their lien, I think their lien date is January 1st, so that may not be one, but we see a lot of aircraft hangared in, Oregon or Washington or Montana, or kept there, for a short time before coming into California, because I don't think any of those states has property tax. But yes, going back to the first slide, this isn't legal advice. We'd have to look at your particular situation and get refreshed on the laws of the other state, but that's basically correct. There's 50 traps for the unwary here in planning for state tax planning. Another question here. So without bonus depreciation in California, you could have a significant tax liability on your California return due to reduced depreciation you can expense. I think that's true. So if you have a large income tax bill in California under if you're taking delivery in the fourth quarter near the end of the year, you're probably only going to get 5% of the purchase price of the aircraft allowable as a depreciation deduction on your California return. Because if you place more than 40% of your depreciable property in service during the last 3 months of the year, then you have to use what they call the mid-quarter convention. So instead of taking the normal 20% depreciation during under the 5-year schedule, you only take 5%. So if you take delivery of the aircraft and place it in service near the end of the year, you're going to get a pretty small deduction on your California return.
And just because it's not deductible in California doesn't mean California residents lose the ability to deduct it on their federal returns. That's a confusion in some cases too.
Yeah, that's a good point. Yeah, California return is separate, right? And your income is reported, largely the same as your federal return. The rates are a lot lower, so there's less tax due. But there's you still qualify for bonus depreciation at the federal level, but you don't get it at the state level. And that's obviously more painful now for California taxpayers because they don't get to deduct state and local taxes more than $10,000. So paying more state income tax doesn't result in more federal deductions.
So Nate, do you have a slide on the end of your presentation that includes the Aero Law phone number so people, if they want to reach out to you, can do so?
I do. Yep. Here we go. We are in the Seattle area. That's my phone number. That's our website. Tom has my contact information. We are here through the end of the year, doing deals and closings that whole time. So thank you all for your attendance and your attention. And unless there's any more questions, I think that's it.